Well, let's get more now on the reaction to the Fed's big move, the markets, the credit markets, and everything else. So we are pleased to be joined by Scott Miner, Chief Global Investment Officer at Guggenheim Partners. Remember, on February 13th with us, he said that we were in, quote, ludicrous season. The S&P would peak on, it turned out, peaking on the 19th. Last week, he said the 10-year could fall to just 0.25%. No doubt mocked for that. But we had the 10-year hit 0.38 shortly after that, rebounding a little bit in the past few sessions. Scott, welcome. I know you're busy. Thanks for taking some time out for us here on CNBC. Was there anything that, I called it a Fed fail at the top, and maybe that's right or wrong. Was there anything that you saw in the credit markets that indicated to you that things were loosening up?
You mean in terms of improving, Brian?
Yes.
No. It's very situational right now. There are many securities that you really can't get bids for. The liquidity in the market is, I think we're in what would classically be a Nash equilibrium problem. That is, that the market has been held up artificially, and there are sellers who'd like to get out, but the buyers who are willing to get in are at much lower levels. And so I think in the credit markets we will see a sudden and precipitous collapse in prices.
Okay, well, Scott, what does that mean, a sudden and precipitous collapse? I'm looking at some of these closed-end funds. I'm looking at some of the high-yield ETFs, looking at some of the debt that I can, and right. A lot of it is already down 20 and 30 and 40%. Right,
but those are interesting, Brian. Those funds have more liquidity to them than the underlying markets. So, for instance, a closed-end fund today in high yield might be down 3%, but I've seen stuff trade down 15 to 20% in the closed-end fund market. Now, you could say that's panic, and yes, I think it is, but it's also showing you the lack of liquidity. In the institutional world, institutions tend to have a little bit more flexibility. They don't have to sell a security as opposed to in the more liquid markets like the stock market, where a specialist has to make a bid every day and there's always a seller. So I think that we haven't really seen prices marked down in selected asset categories. Probably the most vulnerable, high yield and bank loans are still vulnerable, but right now in terms of having true price discovery, I think asset-backed securities, CLOs, whole business securitization, aircraft, those are the most vulnerable places.
And I'll let everybody else jump in here for a second, but I want to ask you one more. We talked about it, QE, Scott. Obviously, I'm going back to 08 and 09, TARP, TALF, some of these programs. Would you describe what the Fed did as those, and if not, do you think that we're going to need a return to those types of direct buying programs?
Well, let's talk first. There's a number of things you're bringing up there, Brian. There's quantitative easing. I've always argued that Treasury bill purchases were QE. Now there's no argument anymore because they're buying across the yield curve just like they did with QE. The Treasury bills that are maturing will get reinvested across the yield curve just like QE. So, we've definitely engaged in quantitative easing. Our view is that if we are not already in a recession, we will slip into one very soon. And the analysis that we've done shows that it will probably take about $4.5 trillion worth of asset purchases in order to stabilize the economy. On the TARP side, TARP is a creation of Congress. I think that that would be the appropriate thing right now. One thing I'd like to remind the policymakers when I talk to them is TARP was a money-making opportunity. And if done correctly, it can be a money-making opportunity again. But I think the TARP program here would probably have to be more like $2 trillion versus the sort of $700 billion that we did in the last downturn. Mm-hmm. And TALF, if we have TARP, then we can do TALF. And TALF would be a great idea to provide financing for illiquid assets for people like me who manage client money because you can't get liquidity, or sorry, you can't get financing to lever your positions, and a lot of investors like hedge funds like to lever their positions.
Scott, over the fall, in the fall, we talked about there was huge volatility in the bond market, and we're talking about 10-year yields. Over the course of the last week, and Brian just alluded to this, we've seen 10-year yields go from, I think, 35 or so basis points to where they currently are today, 80-something basis points. When, if you think about that, that is an astronomical move. And then you've seen 30-year go from 1%. So I think they close at 1.4%. I mean, one of the mandates, and I'm air quoting, you don't see me, of the Federal Reserve is price stability. Well, guess what? There is zero stability in the bond market, and the volatility in the bond market is at levels where it should never even be close to. What does that mean?
Well, Guy, I think what it's telling you is that there's a high degree of illiquidity, even in the Treasury market. There's a high degree of uncertainty. As people come in and try to, do purchases of Treasuries, the bid-offer spread has widened quite a bit. An off-the-run 30-year bond, for instance, that is the bond that was the long bond just a few months ago. Yesterday, we were getting quotes that had a bid-offer spread of 1 point. That's the sort of bid-offer spread that you would normally see in junk bonds. As for the movements, I mean, they're mind-numbing. Now, a couple of days ago, we had the 30-year bond go up in price by 7%. If we came in and the stock market were up by 7%, people would be stunned. And bonds are the low risk, supposed to be low volatility, low risk. So, it's definitely telling you that it's chaotic. People are probably overexposed on certain asset classes that they shouldn't be. And, we have a big dislocation here.
Hey, Scott, it's Tim. Again, thanks for joining us. One of the things that seems different about 2008, and this isn't a financial crisis, and we've talked about that. So I just want to talk about the duration of clarity. We had assets that bubbled to the surface, dead assets that bubbled to the surface. We had TARP, we had TALF. This all happened within about a 2.5-month span, at least when we got to the climax of it and the begin to repair. The current issue with the coronavirus is one that what we understand is we probably won't totally understand the impact socially, therefore economically, and in terms of the stoppages for almost 2 months. How does this make that recovery process and this policy process and this market kind of dynamic get worse, frankly? This is what troubles me.
Well, the first thing I would say, Tim, is that we're not in front of this. The policies that were proposed last night by the president are not adequate to address the problem. The scale of what they're attempting is not adequate to address the problem. And, as we see, Major League Baseball cancel its season, we see Disneyland closing. I joked today, I said, we're not going to have anywhere to go to spend any money anyway, which means the economic damage here is going to be much larger than people anticipated.
Let me ask you that, Scott. You're part of the ownership team of the Dodgers. Is the baseball season going to go on?
Well, what I read this afternoon in the Wall Street Journal is that MLB has canceled. I don't know if they've canceled the entire season. I've been
spring training for now.
So, spring training. I mean, I think it's a question mark, Brian. They say it's going to go on. If it does, I hope you'll come and be at my birthday party at Dodger Stadium on the 28th of March.
I might have to walk there if it's in California. Is the problem, Scott? I mean, it's. I appreciate that. Listen, was there any? You can do stocks too. Was there any indication to you that there is a floor nearby in the equity market?
Well, it's interesting. We are closing here, or did close, just on the uptrend line in stocks for since 2009. If we continue below this level, Brian, it's the end of the bull market. When I consider, something like the Spanish influenza, the drawdown in the Dow Industrials in the Spanish influenza was around 37%. We're down about 28% right now. And so I think we're due for a pause. But, I'm looking at those lows that we got to in December of 2018 as probably the next support level, really. And, tomorrow's going to be a very interesting session because if we break that trend line, that's the end of the bull market. And interestingly enough, equities are pretty much unchanged since the inauguration of the president.
Hey, Scott, it's Brian Kelly. So you were talking about how much stimulus might be needed and that we might already be in a recession. And by my count, I think you came up with somewhere around $6 trillion. And that seems like a pretty big package. So my question is, if we are in recession, how deep of a recession do you think we're looking at? And how long do you think we're looking at one for?
Well, those are great questions. I mean, typically a recession lasts about 18 months. There's a period here where we're going to have a sharp contraction in consumption if for no other reason we don't have anywhere to go to consume. So consumption is the biggest driver in GDP. So we could see a drawdown in economic growth in the second quarter. That's the same as the drawdown in economic growth that we saw during the financial crisis. So, I would anticipate that. The problem is once you do damage to the economy, even if the coronavirus goes away, the weakening of the structures of the economy, such as the airlines and other businesses, is going to have a permanent impact, or let's say a prolonged impact, on the behavior of the consumer and the business. And so it's going to take a while to rebuild that confidence. So I really don't see us, having this thing turn around very fast. And that's one of the reasons why I may be a bit more bearish on stocks than some other people.
So Scott, just talking about the last two recessions, the S&P 500 basically got cut in half from the highs in 2007 to the lows in 2009, from the highs in 2000 to the lows in 02, 03. So, given all the uncertainty right now, I mean, is that what we should be expecting here? That we're going to see the S&P 500 at half of the 3,400 that it traded at on February 19th? And then the other part of that question is, think about both times we had those recessions and think about where interest rates were, where Fed funds were, where the Fed balance sheet was. Is it going to be different this time? Does it have the potential to last much longer?
Well, look, I think I was on the show a month ago with some of the cast of characters we're on today with, and I said that I thought stocks could ultimately be 40 to 50% lower than their peak. So, I mean, we're playing this thing out exactly as I had expected. In terms of the size of the stimulus, I think that reflects the fact that we don't have a lot of tools here. If interest rates were at a higher level, or if that we had other structural forces in place, it could help us. But the reality is that it's going to take a lot of liquidity from the Federal Reserve if the policymakers do what they did in the crisis, which was lean on them, and it's going to take a large bailout of some kind, a large support package from the government, because corporations today are so much more highly levered than they were at the time of the financial crisis, and they're much more fragile.
But companies are, Scott, but not the banks in the same way as 07, correct? I mean, you don't see any chance of this becoming a banking crisis, do you?
No, I don't think so, Brian. I mean, obviously, if we have a wave of corporate defaults, which I expect, credit conditions will tighten. That is, it'll be harder for businesses to get bank lines and bank revolvers. But the more important component of financing is the bond market. And, we've already got the bond market shut down. It's virtually impossible to do a new issue, even for the highest quality borrowers. And, until we get some confidence back into the market, we basically have no access to debt or capital. But, the only reason people are going to be looking for capital is to cover negative cash flow. And the market's not going to look kindly upon that.